Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is your favorite show, What's Hot, a show that focuses on the biggest buzz on the D Street. And today we will be, of course, focusing on all the stocks that are truly buzzing on the back of the Q3 numbers and, of course, a lot of news flow related moves that we are seeing today as well. We are also going to be focusing on the options market comparison between NSE, BSE, and we are also going to be seeing how the premium turnover comparisons are placed there. We will also focus on how Indian and US markets in terms of options are focused on, because remember, there's a lot of action on the futures and options space from the government, from the SEBI, and we need to find out what exactly is happening and why such actions are taking place as well. In terms of the earnings, our focus will be on Titan after the Q3 earnings. We will also focus on Apollo Hospitals, brokerage houses, the targets that they are giving after the earnings here. Jubilant FoodWorks is also in focus here, along with the earnings reports that are coming in from brokerage houses. That's something that we will be focusing on. BHEL OFS is another stock that we will focus on as well. But let's quickly first welcome our guest on board. We have Mr. G Chokkalingam now joining in on the program with us from Equinomics Research. Warm welcome to you, sir. Good to have you with us as always. Let me quickly try and understand from you, how are you viewing the markets at this point in time? Despite the good news flowing in on the back of the US-India trade deal, we're not seeing considerable amount of enthusiasm. The markets have reacted positive and they're staying afloat, but there's no runaway rally that we are seeing, despite the fact that the biggest overhang on the markets has been removed. Last entire year we kept on waiting for the US-India trade deal. Finally the contours have come in. They also in large aspects seem to be favorable for the Indian markets and export-oriented sectors. But despite that, we are not seeing that runaway rally. What are you making of the current mood in the market?
Yeah, very interesting and relevant question to the current market conditions. There have been two problems for the market. The one is, as you rightly put out, the trade war, tariff war. Now that is getting resolved, and signing agreement with the European Union, and secondly, reaching to US with amicable solution. Third, signing FTA with many individual countries. I think it's a landmark achievement. This is going to help the market in a very big way. Still, why market is not rallying, I will answer later. Second, the concern has been the liquidity. The promoters of listed companies have sold close to 2 lakh crore worth of shares in the last 2 years. IPOs have taken away about 2 lakh crore. FPIs in the secondary market, although they made some investment in primary market, in the secondary market, they have taken out nearly 2 lakh crore. And then, lot of newly listed companies, lock-in period is getting expired. And fifth, lot of small and mid-cap stocks are down anywhere from 10-15% to 50% from the record high level we saw in September 25. Because for small and mid-cap stock, September 2025 is the benchmark, because from that day onwards, majority of the stocks are down only. Now, these have been two concerns, but the first concern, as I explained, is getting resolved, and Europe and US account for more than 3/4 of total exports of goods as well as services. It's a very remarkable achievement. But the liquidity issue is not yet getting resolved. The retail investors are still going through difficulty. A lot of small and mid-caps are yet to recover. So, and also added to this, a lot of retail investors seems to be doing portfolio restructuring, because many people would have had a long-term gain and also short-term gain. So it seems they are booking, losses to offset those gains. So that is why, a lot of beaten down stocks are still getting beaten down. So while the first issue is addressed, the second issue is yet to be addressed by the market. But I believe there is a moderation in the IPO. So going forward with the new financial year, with new financial year income, things would improve for small and mid cap. So slowly the FIs selling is also getting moderated, and I believe the FIs will come back to Indian market in new financial year. Definitely 1 year forward earning in April will give a lot of comfort and confidence. So I am extremely bullish for the first time in the last 6 months. I believe the worst is behind us, and I believe firmly that small and mid cap stocks will outperform Sensex and Nifty over the next 6 months' time.
Right. But we have to also tell all our viewers what really has happened is that the US has now revised its fact sheet on the recently announced historic trade deal with India as well. They have removed the reference to pulses, changing the wording related to $500 billion of purchase commitment and more. The two countries have announced reaching a trade deal last week, and after which the White House has now released this fact sheet on Tuesday describing what it calls the path forward. Now, in the earlier version of the document, Washington had said that India will eliminate or reduce tariffs on all US industrial goods and a wide range of US food and agricultural products, including the DDGs, that's dried distillers grains, red sorghum, tree nuts, fresh and processed food, certain pulses, soybean oil, wine and spirits, and additional products. Now, the updated fact sheet no longer carries any mention of pulses. In another change, the fact related to India's proposed purchase of goods from the US has also been modified. The earlier text had stated that India was committed to make a purchase of $500 billion from the country. Now it has been changed to intend. It said India committed to buy more American products and purchase over $500 billion of US energy, information and communication technology, agricultural, coal and other products as well. However, the revised version has removed the mention of agricultural goods from the text. It now reads, India intends to buy more American products and purchase over $500 billion of US energy, information and communication technology, coal and other products as well. Those are some of the important changes that have occurred. Furthermore, the White House has updated the fact sheet, also removed the text relating to India's removal of digital services taxes as well. So those are some of the changes that we are seeing at this point in time. Do you further see, Mr. Chokkalingam, this is in advantage towards Indian exporters and now some more clarity coming in the initial statements?
Definitely interesting data points you highlighted. My confidence comes from the couple of facts. Till a few weeks ago, we were really scared. I mean, as an analyst, I was really scared because, we are all talking about goods exports, but we are sitting on more than $100 billion of service exports to US. And that is more important than goods exports. The margin in service export is much, much higher, and the impact on the employment is much, much higher in service exports as compared to goods. So the way the things were going with the 50% reciprocal duty proposed, so we were really scared whether this tariff war will lead to a sort of chaos for Indian economy, ultimately in terms of curtailing even India's service exports. So now with the the talk taking place, and some proposals have come on in cutting down the duties on goods. So one fear is gone that it's not going to impact at least service sector very badly. Yes, now these new issues have come up. Definitely they are negative. That is one reason the market is a little nervous, not rallying. I agree. But I have been saying last 6 months or even on this channel, ultimately US doesn't have a choice politically. And I don't want to go into detail, but the geographic location of India and the political environment which India has or US has, I think obviously, they cannot antagonize India fully, which means there is a possibility of further talk and bringing down, because we all know Mr. Trump has been too aggressive, and same gentleman has cut down aggressively also on the downside, not only for India, even for China and other countries. So there is a scope, but at least there is a hope that things are not going to be too bad. And then another important fact is that despite the tariff war, in December, we have improved the goods exports to same America, and we have not fallen very badly. And second, we have signed with the European Union and also so many individual countries. Yes, I agree. There is a little bit of concern, but I am hopeful because of these reasons that the dialogue can happen. Yes, there will be certain sectors will be badly affected. So each analyst has to, or rather, analyst and investor have to be very careful about those sectors. Like yesterday, we saw the Bangladesh getting concession that probably can hit the textile. But I am more worried about overall economy and market. I'm still hopeful. So if you want to be a little cautious, I have been focusing on domestic demand-driven stocks. So that is the best strategy for time being. Avoid export-oriented, particularly to the US. But at the end of the day, I am pretty confident that more dialogue will happen and things would improve. It will not worsen very badly. That is the confidence I am having.
Okay. Any key sectors or specific stocks that you think have become more attractive to you and you are betting big on them after the deal has taken place? And there are more deals in the offing. We do know that we've already signed a deal with EU. Now we have the US and the UK is also in the offing. Basis such agreements, are you betting big on certain sectors or stocks?
Honestly speaking, based on these macro agreements, pinpointing individual company will be very difficult. It takes time. So I should admit that. But then, as I mentioned, apart from those countries, India also signed with UAE, Gulf Council, so many, again on with Malaysia, several trade deals. So a lot of good things are happening. So there is an attempt to mitigate the, even if still possible risk is there from US, there are a lot of successful attempts. Now, even now, I am cautious in choosing the stock. So I have chosen, mostly domestic demand-driven stocks like M&M, Apollo, Geo, ITC, and also L&T. These are all in the large cap. L&T, because the kind of orders they have, it will take care of their business for next 1 year, and extremely well diversified. Technology, engineering, domestic, foreign, all that. So similarly, in the small and mid cap stocks, I have again recommending the domestic demand-driven stock like a Paradeep Phosphate. It is engaged in phosphatic fertilizer, which is purely domestic demand-driven, import substitute also. Then Punjab National Bank, then Bayer Crop is another very attractive, domestic agri thing. So that is what strategy I would suggest, for time being. And Pharma, I would be a little cautious because, what we learned more than the tariff war, what is impacting the pharma sector is the pricing pressure in US. So even with the zero duty we are going through, so I would be a little cautious on pharma, but otherwise these are the stocks, domestic demand driven, I have officially recommended. None of them I hold personally.
Okay, fair point. Let's actually come to some of the earnings-focused companies then and take your view there, Mr. Chokkalingam. We have Titan that has come out with the earnings, and here we've seen the net profit improve by 48% at 1470 crores. Revenue is up by 40%, at 22,522 crores. EBITDA has improved by nearly 55%, and margins have also improved a tad bit to now 10.4% in double digits now. Here, after the earnings, we've seen brokerage houses reports pencil in some upside again. Remember, the stock had already hit a fresh record high before the earnings came in yesterday. Now, for Nomura, the target price that they see is upside of 5%, 4,500 rupees target price, a buy call there. Overall, they do believe that EBITDA growth has consistently improved. Now, jewelry business, they believe, has been strong, both on sales and margins. Watches, they believe there has been a strong momentum in analog, and wearables remains, however, impacted in some aspect. But on Titan, what would you want to say, and how would you want to view the stock at record high prices?
I would, at best I would give only hold call. Yes, performance has been great. A lot of these companies, whose inputs are gold, platinum, all silver, what has happened, the steep jump in the prices, precious metal prices, they also partly helped some of the companies, because obviously these companies have 1 to 3 months inventory. So straight away, the what is already procured, input or semi-finished goods, their valuation would have gone up. So partly that also would have helped these kind of companies to post much better revenue, top line as well as profit growth. But the same point, that the prices are at a very high level, I am not confident whether the revenue growth for the precious metal based companies will continue to be robust. So at best I will give a hold call, because it's a domestic demand theme and a large cap stock. But of course I will have a courage to say that if it jumps another 5-10%, one should sell and move on to undervalued stocks in the large cap space.
Okay, got that. Let me shift focus to some of the other stocks again that are in focus again because of earnings. We have from the pharma and healthcare space, Apollo Hospitals. You were talking about this space. From the healthcare pack, particularly Apollo Hospitals, we do know in the year 2025, it has, has its own share of outperformance. Again, in Q3, we have a net profit uptick of 35%, revenue uptick of 17%. Operational profit has improved by 27% year on year. Margins have expanded to 14.9% as well. We are seeing that the hospital business particularly is seeing an improvement. Healthcare services revenue is up. We're also seeing contribution from the insurance space also increase for the company as well. How are you looking at Apollo Hospitals now, about 5% higher, trading at 7,571 after the earnings?
It's a great stock. In fact, we have covered this stock at the peak of tariff war, because this is the one stock which is absolutely free from trade war.
Yes.
Absolutely domestic demand driven, defensive. And tactically also, it is part of Nifty. So in my learning, I also saw one thing that, if Nifty has to keep going up, you need to find a new opportunities, newly added stock. If there is any potential, they can be in the forefront to take up the Nifty further high, because DI support is continuously coming in. So with this tactical aspect, defensive business nature, I recommend it. But after seeing the results, I have become more bullish. Across all the segments, the profit growth has happened. And if you look at the digital health and pharmacy distribution, the segment profit has jumped by 147%. In the core hospital business, also double-digit growth in revenue and profits. So across all the segments, you see very robust growth, and then the hospital also expanding. So I'm pretty confident that the expansion will continue, and margin improvement also will continue in some of the new businesses like a pharmacy and a digital health company. So I would we are in the process of revising our target price upward further. So we would give a buy call on the stock.
Okay. One more stock that's in focus on the back of earnings is Jubilant FoodWorks from the QSR space. And we have seen a lot of brokerage houses reports come in onto this one after the earnings. Earnings particularly indicate profitability uptick of 32%, revenue uptick of 12%. We've also seen EBITDA improve by about 18%. Margins have improved to 20.5% as well. And we are hearing from brokerage houses like HSBC has a buy call. Target price of 700, and they believe the 5% EBITDA beat is driven by gross margin expansion from the price hikes the company has taken, and the 200 basis points margin improvement remains on track. They also believe the LFL growth guidance of 5.5 to 7% is maintained despite a high base, and there is strong confidence in Popeye's growth as well, one of the best performances that has been seen there. Now, for CLSA, they have a hold rating, a target price of 505. They believe sales have been in line with expectations, but margins have been a beat. The product launch margin remains accretive. And for a Citi, they have a buy rating and a target price of 850. And Jefferies is a highest target among all the brokerages that have covered the stock today to 850 rupees. Now, of course, most of the brokerage houses are talking about the Popeye's posting of third straight quarter of double-digit LFL growth, and that is leading to a margin improvement as well. They also believe that one needs to factor in as to how delivery is gaining traction and dining needs improvement at least at this point in time. How would you really look at Jubilant Foods? It's down by about 1% after the earnings, despite most of the brokerage houses maintaining positive targets.
See, it's a good business model. Is it a very good company? Definitely it is a very good company. But does it have a very good valuation to attract the investors? I have my doubt. At 547 itself, trailing P is more than 100. Now, can I justify this and give a buy call? I have my own doubt. Because if you look at the December quarter, I am not taking a PAT because that is very low due to all exceptional. I am just looking at operating profit, which is up only 22%. So can I give 5 peg ratio, that is P of above 100 when the profit is growing at 22%? So I would rather give old recommendation because it's highly institutional owned. So there can be a tactical opportunity, and also the growth may help to some extent justifying Very difficult, but partly it can justify. So I would give at best a buy call, but I will not rush to buy the stock.
Okay. From the auto space, also we are focusing on Eicher Motors post earnings. So the net profit here rose by 21.3% at 1420 crores. This was again beating the estimates. We also have seen brokerage houses like Jefferies, HSBC, CLSA, and Citi all raise the target pricing, citing the Royal Enfield growth and capacity expansion as well. They see near-term growth momentum sustaining. The target prices also are up to 21% of an upside is being seen there as well. So Jefferies has indicated buy rating with a target price of 8,800 on the stock. The stock has already reacted positively to the earnings, about 6% higher in trade, and the robust EBITDA and profit growth along with improved outlook for Royal Enfield is what is pushing the brokerage houses to pencil in higher targets here. The volume growth has accelerated to 25% year to date in FY26, pointing to the company's plan to expanding capacity by 67% over the next 2 years as well. And they also believe that Royal Enfield may benefit from the rising two-wheeler demand and premiumization, adding that the toughest phase of competition and margin pressure seems to be behind. And that's why Jefferies has also raised its earnings per share estimate by 3 to 4% for FY27 to FY28. Now nearly 7% higher at 77.85. What would you advise investors looking afresh after this result?
I would give hold recommendation. It's a really fabulous performance over the decades. Even in December quarter, it has done very well in terms of revenue profit growth. One can definitely hold. It is around 39p on trailing basis. But if you ask me in auto space, I would give a buy call on M&M, which is significantly lower than Eicher Motors in terms of the valuation multiple on trailing earning. But it has got a certain advantages. M&M, extraordinarily diversified. Between automobile and tractor, and within automobile also diversified. At consolidated level also it is diversified across various businesses in the economy. And most importantly, couple of days back they announced a massive expansion to the extent of 15,000 crore. That is the big positive for medium to long term. And secondly, the tractor industry itself is growing at a very robust level of 40-45% year on year. And that market is almost like oligopolistic, only 3-4 player, and M&M is doing extremely well in tractor segment in terms of growth as well as in terms of profit margin as compared to automobile segment. So if there is, we know pure automobile segment is highly cyclical. So to that extent, there is a little possible risk for Eicher Motors. It is 100% automobile, but M&M 100% diversified and also valuation wise cheaper and expansions and unique business, among the automobile players in terms of having tractors. So that's going to be a very long-term story. So therefore, I would give a buy call on M&M even at current price, but I would give a hold call on Eicher.
Okay, buy call on M&M and hold call on Eicher at this point in time, as Mr. Chokkalingam has tracked these automobile stocks there. One stock we will also show you, we won't have detailed graphics on it, viewers, but we want to definitely highlight for you TVS supply chain shares. Why? Because the stock is up for the third consecutive session today. It's already gained about 21% in the last 3 trading sessions. Today again, the stock is up by about 10 to 13 odd percent, now 11.5%, 120 odd levels can be seen on this one. This is again the December quarterly results, and across parameters and margins expanded as well. We have seen positivity coming in, and therefore the stock is reacting positively there as well. Now, of course, we are also given to understand that the profitability grew to 11.2 crores compared to a loss of 23.8 crores in the third quarter of the previous fiscal. So year on year, it's turned black. Revenue is increased by 11% there. EBITDA has increased 36 or 37%. Margins have expanded to 7.6% from 6.2% earlier. That's why the stock is in focus today. How are you looking at this stock, Mr. Chokkalingam? Finally, the kind of underperformance we've seen in the past, is that in the back burner now?
I doubt whether consistently it will be able to improve and outperform. But let us accept the fact that it is a part of a great management. There is no doubt at all. But the one issue is that extreme volatility at net profit level over the last 5 years, and so trading at around 33-34p on a trailing basis. So I would wait for another 1 or 2 quarter to go extremely bullish. So till then, I would give a only hold call. I would not rush to buy the stock.
Okay. So that's as far as some of the earnings are concerned, viewers. We'll definitely keep an eye out on more earnings for you throughout the course of the day. But we also need to focus on one PSU stock, and that is BHEL. The stock has slipped in trade about 5 odd percent. This is after the government has launched the offer for sale to divest about 5% stake in the company starting today. Under the offer for sale, the center will initially sell a 3% stake with an option to offload additional 2% in case of oversubscription. And therefore, the stock is in focus. The floor price has been fixed at 254 rupees, and it was already decided at an 8% discount to the previous close, yesterday's close of BHEL, and therefore you do see that downtick coming in. The offer also opens for non-retail investors on Wednesday, that's today, and retail investors can now place their bets tomorrow, that's Thursday. On the earnings front, we've also seen BHEL report an improvement in the December quarterly performance. The net profit had risen to 390 crores from 134 crore rupees earlier, aided by the strong increase in the other income as well. The revenues had grown by about 16.5%, but other income more than doubled. EBITDA rose 79% year on year. We've also seen that in the notes to accounts, BHEL has said the impact of the new labor codes, if any, will be evaluated and accounted for in line with applicable accounting standards once the rules are notified and become effective as well. So we'll keep an eye out on that. The government currently holds about a 63% stake in BHEL, remember that. And therefore now the offer for sale is bringing the stock back into focus. How would you advise Mr. Chokkalingam one to really look at this OFS? Is there an opportunity at all for retail investors? How would you really see the stock?
I would, I go by relative basis. I would rather, sell BHL and buy Hindustan Aeronautics, HAL. See, if you look at BHL, the problem is not able to scale up the revenue. You would be surprised to know the annualized revenue now is less than what it used to achieve in 2014. There has not been a much growth in the revenue consistently over the last 1 decade or more than 1 decade. And secondly, it's sitting on high level of inventory and receivable, and trailing P is more than 100, and return ratio is very poor. ROC is only less than 5%. So these kind of characteristics are there for this company for many years. So it actually goes up and comes down. As you rightly mentioned, government is holding 63%. So there is a more and more opportunity for diluting. And we have seen a lot of great stocks from the PSU table. When government dilutes, they don't crash. That is where the valuation, relative valuation, support the stock. But this stock lacks. That's why it is down. The valuation company is not there. So I would, if at all any recovery happens, I would give a sell call, and then I would buy Hindustan Aeronautics. And the kind of order book it has got for next 1 year is fabulous, and a lot of cash on the book, and gross cash is more than even the sales. So that gives me a lot of confidence on HAL. So in relative basis, sell and rise BHL and buy HAL.
All right. Okay. Thank you so much, Mr. Chokkalingam, for sharing your insights on various stocks that we've discussed, the opportunities in the markets as well. We've also, understood from you as far as the US-India trade deal is concerned, the opportunities that present themselves, and how to reach the contours and the fact sheets that are being released now after the announcement, and what does it mean for the overall markets as well. Right now, we are just about holding up 0.1% higher. 25,964 is the level at which the Nifty is currently trading at. We're holding up, but let's see. The gainers are definitely Eicher that we've discussed, Titan that we've discussed, Maruti. Auto stocks are definitely in focus. SBI continues to be up after the earnings as well. These are the top gainers, but on the declining side, you have Coal India, Hindalco, ONGC as those stocks that are declining in the first 1.5 to 2 hours of trade as we are looking at. The Nifty Bank is showing you slight uptick and some buying action there. So we'll keep an eye out on that one. And of course, we will continue to track the market buzz for you through the course of the day. Stay tuned with us. 12 noon is when we will answer all your daily calls queries. Any questions that you have about the stocks in your portfolio or onto your watch list, ask them away, as I will be back at 12 noon now.